So Goldman Sachs earnings today, still top of the M&A league tables, still top of the IPO league tables, but otherwise a pretty weak third quarter, Anthony.
Yeah, I mean, it's all very well being top of investment banking league tables, but they don't bring in the revenue and don't pay the bills. So fixed income trading is the thing we're looking at.
What they call FIC, F-I-C-C,
yeah,
right?
fixed income currencies and commodities.
Yes.
Theirs is down, but basically it's halved from both last quarter and the same period last year, which is way more than anyone else.
Right, everybody's had a not great quarter for that, but
no,
Goldman's
exactly,
is
yeah.
worse.
But I mean, JP Morgan was down 8%. B of A, Citi down in the teens or 20s.
Right.
So, look, this really brings up one of the big issues that firms have got, which is what do they want their fixed income businesses to look like? And someone like Goldman, they're in just about every single business, but they also, unlike a lot of the others, they concentrate on the big ticket, sometimes bespoke businesses, which means that when there's not as much business going on, and last quarter, God knows there was a lot of reasons to not do much business, they're going to suffer a lot more.
Right.
Whereas if you look at, say, UBS or Credit Suisse, which have pulled out certain businesses, they're going to hurt more when the businesses they are in aren't going so well. Whereas the likes of JP Morgan and Citi and B of A have other things that they can bring in inside the banks, their transaction management and all the kind of boring stuff.
A lot of smaller, boring stuff, you're less vulnerable that way. So one thing we've talked about before in the past with Goldman is the balance between what bankers get paid and what shareholders get paid. And there seems to have been some recognition this quarter, at least, that bankers should share the pain or shareholders should be spared it, whichever way you want to
actually, the bankers cut compensation by quite a whack. Normally what Goldman and others, but especially Goldman does is, for the first 3 quarters of the year, they'll sock away as much as possible. And normally Goldman's looking at 42, 43% of revenues and adjust in the final quarter. This time they've cut way back. They've actually dropped compensation set aside by about 8 percentage points compared to last year to 35%.
Which is actually a lot, because 35% of revenue, but revenue is also down about 20%, right?
Revenue's down 20%.
The amount they've set aside, and the last thing they probably want to do in the fourth quarter is sock away some vast amount, so we can expect the bankers to be making a good bit less this year.
Yeah, absolutely. They've taken it down, I think, for the first 9 months of the year. It's still at 41%, which is relatively high, but it also allows Goldman to just sneak above that 10% return on equity line for the first 9 months, which is just about above the cost of capital probably, which is just what you want to see. Because this quarter, even with this, I mean, what they did with comp this quarter actually meant that they didn't put an extra 500 million into the pot. So it's a fair whack of money when you consider they only made 1.5 million in total. So 41% still pretty high. Return on equity for the quarter was 8%. It's good for the first 9 months of the year, at least relative to others. But yeah, I mean, Goldman's really suffering this quarter.
So we'll leave it there on Goldman. We'll have more on other banks as they report, and we'll have more breaking views for you tomorrow.